Welcome to another terrific Tips for Business. I am, of course, Terry, your host. Why? Because you can't spell terrific without Terry. I'm so glad to have you with us here today as we welcome back one of our first guests that we had on the show, Debra Morrison, back early part of last year. I'm so excited to have her on the show because a lot has transpired for her in this last year, and I can't wait for her to share some of that with you. So for those of you who missed that episode or don't know who Deb Morrison is, let me introduce her. She is a CFP, MS, AEP, and is a TEDx and International Transformational Speaker, and now a financial coach to Women Navigating Finances, LLC. This is her new company that she's launched. And she works she's recently worked at selling her fee-only fiduciary financial planning and asset management company, which she founded and she's worked in for 42 years. So she sold that last year. What an amazing accomplishment. A lot of people talk about 2020 being such a terrible year. And here we are having people make such amazing changes and transformations in their life. Debra's been an expert and has been featured on CNN, ABC, MSG's Metro Money. Sorry, I'm not familiar with that one. And CNNfn, The Wall Street Journal, USA Today, New York Times, Fox, National Business, or Nation's Business, Ladies Home Journal, Business Week, and Reader's Digest. So she's very well known in the country for her financial background and understanding. The other thing that she's done in this last year is she's become a certified grief coach and an Amazon best-selling author of My Husband Died, Now What? It's a widow's guide to grief, recovery, and smart financial decisions. Absolutely amazing. Now, with some of that, I'm sure you probably know why we invited Deb back. She's absolutely a wonderful guest to have, and she has so many amazing stories to share with us. So join me in welcoming Debra back to the show. Hi, Debra. Welcome.
Terry, thanks so much for having me back.
Absolutely. It's my pleasure. And forgive me, it is still coffee time for me. So I'm going to be sipping on my coffee this morning.
You bet. You bet.
Yeah. So talk to us a little bit about this transition. You went from this financial fiduciary fee-based kind of organization last year. And that's really what we talked about is we talked about your hike up Mount Everest. Yes. And now you're doing more coaching, consulting kind of work. Talk to us about that transition, kind of what inspired that for you.
Well, actually, Terry, it was the universe working in wonderful ways. And I was about to promote my very esteemed coworker. She had worked with me, Asta, for 4.5 years and just elbow to elbow, and she could finish my sentences. And I was speaking with her about becoming a partner. And we had the conversation and continued to have the conversation. And she said, you know, if you're ready to sell the company, I'm ready to buy it. It's like, oh my heart, you know, it came up that swiftly for me. And so like, after I got a pulse again, I thought to myself, everything for a reason. So let's talk about this. And it really, I said, we had a very elongated conversation, and I said, let's sleep on this. And we came back the next day, and I said, do you feel differently? And she said, no. And she said, do you feel differently? And I said, no, I actually don't. There's a whole lot of questions, and yet there's a sense by which you can get comfortable with the fact that this chapter is okay to be finished. It's okay to stop something, maybe in your peak, right? Athletes do that a lot. Some athletes wait too long. Some people wait too long. And so I felt that it was God's hand and Asta's ingenuity and courage and so forth to say, yes, I'm ready. And I couldn't argue with her. She was completely ready. I trust her completely. And so we went about for a whole year figuring out all the terms and so forth. And I am just ecstatic. We closed the business last September 16th. And I immediately launched, actually I launched in the summer, Women Navigating Finances, because I knew I had more to offer. I had 42 years. Now it was child labor. But I had 42 years of not only book knowledge and accreditations and so forth, yet client knowledge, right? I had marshaled clients through foreseen and unforeseen, expected and unexpected events. And some of this is so valuable that I didn't want it to lie fallow. And so I said to myself, you're going to coach women. Now, the challenge, Terry, is that heretofore I have taken on clients and I have spoken to groups of people, and I have been able to offer them my individual services, my firm's individual services, and marshal them completely through and see them through and elbow to elbow and hold or shoulder to shoulder and elbows locked with each other and absolutely ensure their success, because I was in charge of the implementation largely, right? And the integration with their changing goals and objectives. And so the coaching cuts me short of that. I can't advise anymore. And I need to almost always bridle myself, right? I mean, I was raised on a farm, right? Put that bridle on your, put that bit in your mouth, you can still add a terrific amount of value, Deb. And I felt quite confident that I could. And I think that from the responses from my coaching students, it is evident that I can help women in particular who have been poorly socialized about money, but I can help people navigate what I make an analogy, and Terry, I'm always great for analogies, navigate their financial car and keep their financial car's tires out of those really deep potholes. And if I can do that for people, I'm saving them time, money, angst, and then I kind of prepare them with the wherewithal and the questions to ask their fee-only planner. So you had said, just on one occasion, fee-based. No, we were fee-only. And there's a massive distinction, like the difference between like a grape and a watermelon on steroids, right? So the point is, there's really, I suspect there's a scintilla of conflict of interest potential with fee-only, but by and large, no conflict of interest. We're not selling product that would otherwise generate a commission. We're not in any way tainted by the advice we give. And we had how many? 45 clients, and there were 45 agendas, and we had 45 plans, and probably not 45 asset allocations, but you get the point. It was so individualized. So fee only is one of the three types of financial advisors, and I'll just review that quickly. Commission only, and so they're going to be paid by their commission, and so obviously they're going to be buying and selling, whether it's stocks or mutual funds or insurance policies for a commission. And I've probably can hold in one hand the number of people that do that without necessarily putting their own agenda, like at least in the top two. As fee only people, we signed contracts professionally, the client's interest first. Now, none of us needed to sign that, and yet that's the edict with which fee only works. Client's interest first. Now, doesn't that seem logical? Like, well, doesn't every financial professional do that?
We would like to believe that, but they don't. Yeah.
No, they don't. And then so fee-based is in the middle. They write a financial plan for you, Terry, and they say, well, this financial plan is going to cost you $1,000. But then integrated in that financial plan on pages 4, 7, 18, and 29, big suggestions to buy life insurance and variable annuities, the two highest paid commission contracts in the world. And so they get the commission on top of the fee, and that's why they are fee-based, but commission on top, like icing on a cake. So fee only is like zero commission, and there's no question we advised people to buy various insurance policies. And to the extent we could get no load policies, we advocated that. And to the extent we couldn't, we worked with agents that we knew were authentically geared towards the client's best interest. And so it was a good marriage, but there was just never any room for a potential client to say, what's in that for you, Deborah?
Right.
Nothing. Your
Nothing.
success. If you're
Yeah.
successful, I win because you continue to be my client, and clients vote with their feet. And we had like a 98% retention rate, and some of them
Yeah.
died. So
That's sad. That's sad. It is what happens though. So in this transition, going from this fee only service where you have these opportunities to manage and look over the financial assets for your clients, to going now to more of a consulting coaching kind of role where you don't have access to that. You had mentioned your biggest challenge is just kind of bridling yourself or controlling kind of what it is that you're doing. How are you kind of overcoming some of that? Because I know that could be a big thing to face.
well, I still advocate, and I give people websites for fee-only planners, and they can search one out, whether they're in the same geographic vicinity or not. I mean, when I retired, we had clients in 28 states. I mean, I had clients I'd never met.
Oh, wow.
So we didn't need the pandemic to prove to us that you don't have to be belly button to belly button with someone to have an effective relationship. So distance was never a problem. But the shift, I think, is that I get to spend so much more time, Terry, with the behavioral finance aspect. And I point to our heads because it's our heads and our hearts that ultimately steer us. They drive our actions. And if in fact women's heads and hearts have been filled with fear-based fear
Mm,
mongering from TV pundits whose veins are popping. The market is crashing. The market is crashing. I mean, that really, prompts people, and particularly impressionable people who look at the TV all the time, to think, I probably should be doing something that they're so excited about it. The market is crashing. So what should I do? And in many cases, you should sit on your hands and not take action at a time like that. Or if we are taking action, not flee for the door, buy.
yeah.
You see, as women, we are hardwired with this kind of bargain mentality. Now, I, for one, am not I hate shopping actually, but I'm such an anomaly. So many women and a lot of men like to shop, right? And
Uh-huh.
so we get it, Terry, on the retail basis. When Macy's or any of your favorite retailers go have a sale, they generally announce it with some type of a flyer or electronic device, a text. And you generally wouldn't go the day before to buy that very same item unless you needed it that day. You would wait for the price to go down, right?
Yeah.
And so when the market's price goes down, I want to have our whole universe poised to think, and because emotions and intellect are on an opposite ends of the spectrum. I learned that in neuro-linguistic programming. And so when we get all emotional and we look at the TV pundits and they're all excited, we tend to get that excitement, and that's the point. They're very good at it. And when we get emotional, that intellect goes bye-bye. So I want to cement the intellect while we're calm. And then when things get tight, whether it's a TV pundit, an emotion, whether it's an unexpected life event, a real tragedy, like a horrible diagnosis, an accident, a death of a partner, child, family member, dear friend, it doesn't matter. I want us to have plans in action. And then when the unexpected happens, we simply pivot. We don't just say, oh, what next? I want us to add the apostrophe S. What's next? Because there will be something that's next.
Yes. And
Absent a plan, we might be desperate. And that
exactly.
throws us into a whole different
Oh,
environment, which
yeah.
is not so good.
We end up in a tizzy for sure. So I just had this envision of getting an email from Debra Morrison going, guess what? Flash sale. Everything in the marketplace is 50% off.
Come on, the water's fine. Come on in, jump in, the water's fine.
Yeah. So that's really funny. And I love that because you're right. You're absolutely right. And I studied finance a little bit. I actually worked as a branch office administrator at Edward Jones, one of my first jobs when I was down here in North Carolina for one of the local branches, and learned a lot about the annuities and the stocks and the bonds and the CDs and all of that kind of stuff, Roth IRAs, SEP IRAs, how you make those kinds of determinations. And it was really fascinating to me that every time there was some scary news going on, the phones would ring off the hook, people wanting to like do something. So you're right. Everybody like panics and wants to do something because of the talking heads. So definitely great advice to, if you're going to do something, buy or
Yes.
sit on your hands. Don't do it.
Yes. Yes,
Just be still.
exactly. I mean, there's some sophisticated strategies that you could sell. So like a sinking market basically sinks, not always, because there's correlation coefficients and I can get weedy. But the point is, generally, if there's a good reason to capture a tax loss, we might go ahead and sell in a market downturn, so long as we go ahead and buy something else that's equally depressed. Now we've logged a tax loss, which is going to give us dollars in the end, or leverage against those tax gains. So we leverage our capital gains against our capital losses, and then we take the difference as a deduction to $3,000 annual excess of losses over gains. And then it's carried forward if we have extras. So actually, on the October 19th, 1987, when you might remember the US large stock market, which is otherwise represented typically by the Standard & Poor 500, dropped 28% in 4 hours. And so what we did was log a lot of losses that day. And we did so again in 07 and 08. We logged a lot of losses and bought into similar securities, not the same securities. You run afoul of the 30-day wash sale rule, but the similar securities, because they're lower priced too, and then ride them up, you see? So the fact is, you can do some sophisticated selling strategies during a market decline and a market crash, if you will. Yet, ultimately, you really probably don't have that at your fingertips if you're not working with a good advisor, a fee-only advisor who strategized with you already.
Right. So that's already part of your plan and you know what it is that you're doing. And, I follow a lot of different financial advisors on LinkedIn. And one of my financial advisors that I follow had mentioned that a similar strategy where you take advantage of the loss to mitigate some tax liability. So that's a brilliant idea, not one that I've heard of before. So I was really like, oh my God, that's so smart. So for those of you that are listening who are thinking, gosh, am I in the right market? Am I in the right portfolio? Do I have the right mix going on with my financial future? Now might be a good time for you to get in touch with Debra and her team and have her kind of be that guiding voice for you to just double check to make sure everything's where it's supposed to be. So what's the best way for them to get in touch with you, Debra, to do that?
Well, they can email me at team@Women Navigating Finances. It's a mouthful, but womennavigatingfinances.com, team@womennavigatingfinances is an email. Pop onto the website. You can get download a checklist. And then I have a Facebook group, Women Navigating Finances. And I welcome anyone to join that group. That is exclusively for women. And so in that group, we have a public group. And then, of course, I have a paid group. And then we have some one-on-one coaching opportunities. But let's get our feet wet first. See if you like the languaging, right? See if you resonate with my analogies, because I'm a little quirky. Actually, I'm a lot quirky. I mean, I talk about squirrels, right? And recipes and spices in your cabinet, right? And I make analogies. One, because I'm perfectly comfortable with money. It doesn't affect me in the least. I always have money. I always have money nearby to use as illustrations, and not just singles, $100 bills. And I do that because I understand money as a tool. This is currency for what I want. It's currency for what you want. And it's just that. It's the tool that gets us from here to there. And if we use that money and use the investment strategies that are smarter than not having an investment strategy at all, or a poor investment strategy, we will turn our $5 bills into 50s, and 100s. And then once those monies are there, they do something like grow while we sleep, compounding, and they grow and they grow and they grow and they grow. And if you keep your hands off of it, see, Terry, I make an analogy. Many of us know how to follow a recipe, make a chocolate cake, 350 degrees, 50 minutes. We mix up all the ingredients, good ingredients. We don't want to waste them, good ingredients. And the recipe says 350 degrees for 50 minutes, 50. We pop it in the oven. So here's the analogy to the stock market. We have all these good ingredients, all these good stocks and bonds and pieces of real estate, et cetera. And then we pop it in the oven. And if we get real curious and open that door and jerk that cake out in 10 minutes, it is not going to turn out so well.
It's still a bit sloshy after 10 minutes. Yeah.
A lot, right? So if we go into the stock market, which is typically, reserved for anything, I used to say 7+ years, maybe 5+ years now, and we decide to pull out before that duration, it will likely be very disappointing. So we have to cordon off our goals. And then for those goals that are time specific, everybody should draw a horizontal line on their paper. Just a horizontal line on a piece of paper, 0 to 12 months. I'll go from this side because that's how I think people are seeing this. 0 to 12 months, 1 year to 3 years, 3 years to 5 years, 5 years to 7 years, 7 years plus. 7 years plus, that's stocks, period. It's stocks. 0 to 12 months, cash money market. 1 year to 3 year, cash money market, short-term bonds. 3 years to 5 years, et cetera. You see the difference. And so if we are very clear on matching those assets with our goals, we are formulating a winning plan.
Interesting. So is that how you work with clients right now and women right now on boosting their money confidence?
Sure. I think that if we learn more and more some of what I call the truths about money, and I have a course with that very name because I'm passionate about getting through all the noise and the media and whatnot. And I go through in the truths about money, various segments. There's 5 segments. Life isn't a dress rehearsal, a complete analysis, pretty darn good analysis of insurance, risk management and so forth, and investments and so forth. And then, bonus stuff, right? So the issue is that women have been a little bit behind because of a whole host of reasons. The socialization has been poor. I'll invite you to your audience to take a look at my TEDx talk called "Feel the Financial Fear and Do It Anyway." I said in that, in the olden days, it was like, "Don't worry your little head about that, Betty. Bob will handle it."
Right.
In a heterosexual marriage. Well, that's okay for Betty if Bob doesn't come home one day and trade her in for 230s, or Bob doesn't die prematurely.
Right.
So I think if it is to be, it's up to me. And I'm speaking to us women in particular, because we got longevity that's going to probably or actuarially take us out longer than our male counterparts. And so if you're partnered, God love you, that's a bonus. But it does not excuse us from the responsibility of acting on our own. Like, just because there's 2 people in a boat doesn't mean that one person can sit there and let the other one row. I mean, for a few minutes, yeah. But for a journey called life, no. If you're lucky enough to have 2 people in that boat, both people need to be sharing in the rowing. And so what I don't want women in particular to face is grief recovery, and learning about finances all in the same chapter. Yeah. That is tough, almost impossible to do it right.
Well, mostly because grief, like excitement, grief clouds our mind. It distracts us and it makes it harder for us to remember things or know what it is that we're doing. And so we can make decisions that are not of sound mind because your grief is overcoming that decision-making process. And so, yeah, absolutely. Getting that financial confidence before something happens is super important. So talk to us a little bit about some of the challenges that you are seeing your people go through in this navigating women in finance. What are some of the challenges that are coming up for these ladies that you're helping them through?
Well, thanks, Terry. And that is an excellent question, because I named my company Women Navigating Finances because finances takes in the entirety of risk management, estate planning, income tax minimization, and investments. But so many people just focus in on the investments, and they do their research, and they're really buzzed about like getting the PE ratio and knowing the 20-day, the 200-day moving average, and they get candlestick charts and they go nuts about this stuff, right? Like, the market is pretty efficiently priced. If you think you're going to buy a large cap stock and make any gains because you think you have a tip, here's the clue phone, probably not, right? Now there's going to be a bigger spread in small cap stocks, but generally not so much information about small cap. So I'll take to my original stance, and that is buy the market. Don't try to beat the market. That's what all this research is about. That's what all this do-it-yourself market investment research. I think I can beat the market. 42 years. Made a lot of financial mistakes myself.
I'll say the house always wins.
Buy the market. And so if you buy like an index fund, which is a fancy name for a basket of a whole bunch of whatever it is, bonds, stocks, Standard & Poor's is 500 US domiciled large cap stocks, generally multinational now. But if you buy the index, over time, you're going to do quite well. Thank you very much. As a matter of fact, there's a whole lot of evidence that says you'll beat the active money managers that are attempting to one-off the very indexes they're trying to beat. And that's good for 1 or 2 years when they're right. But if I'm interested in rolling returns, see, now we're getting into some interesting vernacular, like, because anybody can data mine. Oh, our fund did 49.6% in 6 hours. Good. Like, you spend a techie, you paid a techie $25 to figure out the last 80 years. And those were the 18 days, right? No. Rolling periods. What was your return? January 170, January 180, January when markets closed, January 270, January 280, January 370, 1970, etc. And 2008 and 2007 to 2017. What are those rolling period returns? Because you can't hide a bad year there.
True.
See, the truth, the kimono is open. You can see.
Yeah.
What has happened?
Well, and I think one of the other challenges is there's so in the financial world, everything is so regulated about what can or can't be shared when you're a captive agent.
Yeah.
That there's a lot of misinformation or no information about how these different markets work and what these things are actually doing for us, because agents don't feel like they can actually inform people, because then they feel like they're violating their contracts, which could mean a loss in their securities licenses.
Mm-hmm.
So then there's a lot of this like nebulous kind of stuff going on when it comes to the financial markets. Unless you've studied finance, you don't really know what's going on. And so not being a captive agent really opens up that ability to say, okay, I can dig in and look at these things because of my track record and my history. And because I'm not a captive agent, I can share all of it with you. Because what are they going to do to me? They're going to take away my securities license. I'm not trading anyway. So, okay.
Yeah,
right?
that's a good point. And then I'll add to that, Terry, that the continuing ed requirements for a fiduciary, and look up the word fiduciary. It's the highest standard in the law. Yeah. Fiduciary, financial planners, and attorneys, the highest standard. Yeah. And the continuing ed credits that were required of us as practicing fee-only advisors was law, tax, risk management, insurance, investments, etc. I mean, it was a panoply of disciplines such that we could recommend and advise dovetailing strategies that really made sense. An insurance agent is if they have continuing ed credits, it's on, how much commission is in this product versus that product. And so it's limited. Wow. And so I'm not trying to bash every commission agent. There are a few that are reputable. And yet when you can do business these days, and that wasn't always the case. I mean, I began a fee-only planning practice in 1999. It was the first year you could do it. I was like completely out at the front with a machete, saying, okay, I want to do this. And I gave up almost 6 figures of renewal commission. Then imagine what that would have blossomed to today. So when someone says, oh yeah, I'm just kind of like you, my nephew's at Merrill Lynch, I was like, not so much. So, I mean, I'm able to then say to a person, listen, I looked at your tax return and you're giving $10,000, to your church or synagogue every year. Why don't we just tell the church or synagogue, you're just going to, lump that and you're going to give it all this year, $100,000. And we're going to take some traditional IRA, convert it into Roth IRA to the extent that $100,000 would otherwise be declared as ordinary income. But now the $100,000 gift to charity or a charitable, you don't even have to go to Remainder Trust, donor advised fund. would enable you to offset those. So now you've brought some traditional IRA, which is going to be taxed at ordinary income, over the tax bridge with zero cost because you did an offsetting $100,000 deduction. You see that kind of thing. And my clients, come into their church and they look at a huge round rose window while they're still alive. And it says donated by the people. And they are so proud that they could do that. Now, were they going to do that with their $10,000 a year gift? No, they weren't. So we gave them a complete tax benefit on their own personal return and their own personal net worth. And we benefited the charity that they loved. How great is that? Those are bucket list items. Those are dreams. And I want to uncork the dreams. And often it's teasing that out that's the real work because we've been tamped down. I mean, there's a whole lot that has tamped us down, even before the pandemic.
Well, and the other component to that is there's a real mistrust because there's been so much misguidance or so much mystery around the industry.
Yeah.
There's a mistrust there. If I tell you everything, and I run into this in my own industry as a marketing director, marketing advisor, people hear marketing and they think, oh, you're about to sell me something, because that's what most marketing agents do is they're selling things. Yes. I'm different because I'm not a marketing agent. I'm not captive to any one person except the businesses that I'm serving. I'm captive to them and only them. But I run into the same thing. There's this mistrust. So when somebody says, well, what's your budget? Everybody wants to be like, do I tell them my real budget or do I tell them 25% of my actual budget? Because exactly. I don't want to tell them my real budget because then they're going to go to the max of what my real budget is. And I don't want to do that. Right. Yeah. And so there's this, how many different walls and angles can I put up? And I'm sure you run into that too, when it comes to tell me your financial goals and future. And people are like, how much should I really tell her? Because if I tell her everything, she might take all of this, 6-figure, 7-figure kitty that I have over here and invest it in some crazy ways. And the next thing I know, I'm not going to have it anymore. Yeah. And so I don't know if I want to tell her everything. Maybe I'm only going to tell her 10% of what I actually have and have her play with that. And let me see how that goes. And then maybe if it goes well, maybe I'll tell her about another 10% that I have and see what she does with that. And they're sneaking in the little bits. And so they're not being fully transparent. So is there something that we can do as individuals that can help lower our guard when it comes to having those transparent financial conversations with our financial advisors so that we can really get the financial support and advice that we actually need?
Well, it is a good point. And we inherited an awful lot of clients that had been burned and burned by people they had gone to church with for 40 years, widows whose husband best friend is an annuity salesman and tied up all their liquid money into annuities. I get it. We went to the insurance commissioner 4 times and unwound unsuitable annuity sales. Believe me, and we did it at no charge because it was the right thing to do. So what I found, and I can resonate with what you're saying, Terry, yet when people came to a fee-only advisor, it was kind of like, I really didn't know you existed. Yeah. What you're doing is what I want. And so there is a tendency when we're in conversation about, well, what is it? Well, two things. One, what's the spear in your chest? What has driven you here? Because, you didn't just, decide to come here instead of the grocery store. What has driven you to a fee-only planner? You had a bad experience with someone who is commission-driven. You want integrity. You want unbiased advice, and you're willing to pay a fee for it. Number 2, what are your goals and objectives? And often when in just the initial conversation, we talk about, well, did the accountant ever suggest this and that? And they start to get an idea that there's a whole lot of possibility. And then the experience helps that what's between my ears and other people that have come before you and tax laws and my experience can give you the head and shoulders vantage point above your do-it-yourself neighbors. And so we actually had people completely open up. It was actually quite, I never even thought of it, frankly, because so many people just did it so quickly because they were so relieved. It's kind of like, I'm home.
Yes.
And we're like, yes, you are. Come home. You're our family. We are going to pay attention to you. We're going to call you and give you advice as to when to move and which actions to take when. And we're going to initiate the conversation that involves your attorney when necessary and your accountant. And we're going to be the quarterback to have the whole thing working well so that, guess what? You can live an untethered life. Imagine that.
Imagine that. I want to take just a brief pause and thank all of our listeners and our active tuning in audience right now for jumping on this terrific tips conversation with the fabulous Debra Morrison. She is talking about boosting your money confidence today, and she's bringing 42 plus years to the table when it comes to financial management. And we're so thankful to have her here with us today. If this conversation is serving you, do me a favor, hit the like button down below. Go ahead and subscribe to the channel so that you get notifications when we go live, because we do have amazing guests on this show. We do go live every Friday for at least 30 minutes. And today we've got a special treat. We're going to go ahead and turn on our Clubhouse. So for those of you who have Apple, feel free to go and find the Terrific Tips podcast room in Clubhouse. It's Terrific Tips for Business with Debra Morrison. The room is now open. We would love to have you tap into the conversation. This is your opportunity to ask Debra some questions about your financial money confidence, boosting your money confidence. What are questions you have? We want to hear from you so that we know that we're providing the best possible quality, because that's what Terrific Tips was built for. It was built to be a platform for everybody to share their expertise. And it was built. Whoop.
Oh, that was my fault.
Okay. It was also built to provide value to you. And I want to make sure that you are getting all of the value out of these conversations that you possibly can. So go ahead, join us now in Clubhouse. The room is open, and we are going to keep this conversation going here live on YouTube and see what we can do. I've never done it this way before. So come play with us. And Debra, what's the best way for them to get in touch with you again? Let's go ahead and give that information.
Thanks, Terry. Well, pop over, join my Women Navigating Finances Facebook public page, or email me at team, T-E-A-M, at womennavigatingfinances.com.
Fantastic. Thanks so much, Debra. All right, so the room is open. We'll see who joins us and be able to tune into that conversation as it happens. You know what? I could really use a headset so this isn't echoing. But I'll keep my volume down for now until somebody pops in. And we'll keep the conversation going. So Debra, when it comes to helping women boost their money confidence, are there particular resources that you would turn to or recommend they turn to start tapping into some of that knowledge base?
Well, there are, is that probably not a good idea? Is it echoing for you, Terry?
I got it. I muted my phone. Is that better?
Yes. Actually, okay. Yeah, that's a smart idea. I'll mute my computer. Is that better for you?
Yeah.
I can't hear you.
You can't hear me? Uh-oh. I can hear you. Okay. So I muted my phone. Maybe if I unmute my phone now, you can hear me?
Yes, I can. Yes, indeed.
Okay. There we go. Okay. Oh, so you know what? That's what I'll do. Here we go.
Excellent.
And now I can turn the volume up here. Thanks for playing along, guys. You know, technical difficulties happen.
Exactly. So, well, there are myriad resources available for people to learn it. I'm really loath to talk, particularly to women, about, well, you just need to be financially literate. You know, that's kind of such a catchphrase, and I just bristle when I hear that, Terry, because women so often are behind the eight ball anyway, because of socialization or their family money messages or religious money messages, that we don't have the time, we don't have the next 8 decades, right, to become financially literate, right? And I make the analogy, like if I took my car into my mechanic because the brakes were squishy, I would say, listen, you know, the brakes are squishy, that's my problem. And if he came out with this tome, right, of automotive mechanical
I lost you. There you go.
detail, I would just have to hand it right back to him. I mean, how ridiculous is that? I'm interested in my brakes working, right? So there's an aspect by which I'm really wanting women to grab onto cliff notes, if you will. Yet they have to be good cliff notes. And so I take an educational approach. Happy to have anybody come and join my Facebook group, Women Navigating Finances, and enjoy the kind of back and forth that we can do in the chat area. And then I have a paid membership where we dive deep. And now we've actually gotten into a website called betterment.com. It's a robo advisor, and it offers us as a group, and I'm really interested to check in this next Wednesday with people as first Wednesday of May, as to how they're learning from setting up systematic investing. Because Terry, I like to put our head down and just do it, right? So I said, who doesn't have some extra COVID money running around that hasn't been spent on travel and restaurants and so forth, and or stimulus money?
Home renovations. Yeah. And I want to take a minute to acknowledge Pat Chin and Risa. Thank you both for joining us in the Clubhouse space. If you would like to ask the fabulous Debra Morrison questions about boosting your money confidence, just raise your hand for us and we can bring you up on stage. And so, we are also live on YouTube with this conversation. So you'll be broadcasting, but we would love to hear from you. And I look forward to having you up on stage with us. Thanks for tuning in today.
Yes, you bet. Thank you so much. So it's a matter of us, being seekers of information and confidence building. And as I say, I have a course called The Truth About Money, and that gives us some of the basics. Ultimately, we need to be unit grabbers from an investment standpoint. Now, I'll zero in on investments. A lot of people have just zeroed in on investments to the exclusion of liability insurance, right? And I'm quick to say one lawsuit will ruin your whole morning, right? So you really need to pay attention to the multiplicity of facets of our finances. And I should say that risk being the unknown that it is, we need to attend, Terry, to those uncertainty of time types of risk: premature death, disability, lawsuit exposure, and so forth. So handle that insurance stuff first, long before you talk about investments. But when we get to investments, I want us women particularly to be unit grabbers. And by that, I mean, take the focus off of day-to-day, minute-to-minute price fluctuations and just get units. So I like to advise people to invest in mutual funds first, because there's less overall risk. The risk is spread along several hundred, several thousand, tens of thousands of mutual funds, of stocks, for example, in a basket of mutual funds called, a basket of stocks called mutual fund, versus picking an individual stock where, a lot of your money or however much you have invested is riding on that one stock. I mean, people thought Enron was good too, and until it wasn't, right? So rather than us subject ourselves to that kind of risk, let's just buy a bunch of mutual funds and mollify some of that volatility. Now, how are we going to do this? When the market drops and goes on sale, just like our retail counterparts throwing a sale, we're going to throw in more money. Yeah. And so let's just keep the math simple. If we're investing $100 a month and whatever mutual fund say we're buying is $10 a share, we're going to buy 10 shares that first month. And the second month, if that goes down to $8, we're going to buy 12 and change shares of that. The shares are what I want us to focus on, because we're going to build a storehouse of shares.
Yeah. Hey, Craig, welcome to the conversation in Clubhouse. Thanks for jumping in today. We're talking with Debra Morrison about boosting our money confidence. If you have a question or a thought that you'd love to get some feedback on, just raise your hand. I'll invite you up on stage. Would love to hear your voice this morning. And I appreciate you being here. Hey, there he is.
Come ahead for sure.
All right. Hi. Hey, Craig. Welcome, Craig.
Hello. How are you guys? Hey, you know something? You popped on just as I was closing up my iPad in the morning, and I got a ping, and I needed to come and say hello before I jumped to my next call. But hello, Terry.
Hello, Craig.
Wonderful. I missed you this week. Hello, Debra. It's so nice to meet you.
It's great to meet you, Craig.
How are you guys doing this morning?
We are fantastic.
We're great. And do you have any, Craig, do you have any victories to share about your own finances, or any quick questions that you might like to ask a person that's been banging around in it for 42 years?
You know something? I do not have a question as of right now. I do have a win. Hold on one moment. Sorry about that. Hello. There we go. Sorry about that. Trying to get that closed out. Thank you very much. Yeah, I definitely have a win, and understanding that so many of us, myself, I'll speak for myself, I personally spent so many years understanding, looking at, focusing on the lack and scarcity mindset in my life in so many aspects, from my finances to my health to my relationship. I mean, every bit of it was always about what was not working, what I didn't have. And I just stepped in the last sentence that you had about focusing on the shares. What some people might jump into doubling down or pushing forward, or just recognizing where you're at and saying, I'm good, I'm on my way. That has been a big focus of my life this past year. And I have to say, when I've been willing to see that, when I've allowed myself to stay in that space, that's when I'm able to see the shares. Yeah. If not, all I see is the drop. Yeah. Right? Yeah. So yes, I'm grateful for people like you who are bringing that intentionality and that ideology to other people in the world.
Well, thanks, Craig. And you've nailed it. The intentionality is so important. And so if our intention is to build wealth, that's what everybody says, let's build some wealth, right? If our intention is, and I make a kind of a slope here, as we're coming up the traversing up the hill, if you will, towards whenever, and sometimes we used to call it retirement, but people may or may not be retiring, but whenever we're going to start to take some monies out of that to supplement other Social Security, pension, if we're lucky, income. So while we're accumulating, we want to just be grabbing. And then, Craig, in these difficult times, mentally or economically or politically, we look at our storehouse and we say, okay, this is ours. And if we don't panic sell, if we don't hit the panic button, and we keep amassing shares and confidence, because they do go hand in hand, self-worth and net worth, a lot of connection there. If we do that, then we're going to keep that intentionality on being wealth builders, right? Now, I have another little addendum for when we're coming down, because I climbed Mount Kilimanjaro a couple of years ago and I crested. I was so happy. And so much focus on the way up and everything. And, I fell once, Craig. And you know when I fell? On the way down. Do you know that 87% of the people who die on Mount Everest die on the way down? So let that be a lesson. As we're accumulating, we can maybe afford to make a few mistakes in our investment portfolio or not minimizing taxes. But once you get to that place where you're starting to withdraw from your portfolio, you need to be completely intentional about the integration of tax minimization and from which pocket. And I do a whole presentation with cargo pants and dollars hanging out of various pockets, right? Don't just take it from the most the ready front pocket. It might, this part of this cash flow need this month, this year, needs to come from two different pockets, because there are two different tax costs to these dollars. And so in my case, hike Kilimanjaro, I was completely jazzed and planned for 9 months, trained, all on the incline. And then when we got to the top, I was so relieved, and I never even thought about going down. And, there was a lot of lava, loose lava, and we were kind of skiing with our hiking boots, which was a little ridiculous, and boom, fell right in my butt. And I just laughed. I laughed and laughed. I said, oh my gosh, Debra, this is so what you talk about. Make that intention on the way down when we're withdrawing from our portfolio. But on that way up, Craig, you definitely are right there. Now, one last analogy, because you have to go. I always make an analogy, because people always tune into their watch or their smartphone to see the prices, right? And we're told the prices. We're told what the Standard & Poor's closed at, like that mattered to your portfolio. It doesn't, trust me. Today it doesn't. So the point is, if a realtor came to your house and said, Craig, your house is worth $463,290 today. And you'd be like, why are they here? Whatever. All right, so you shut the door. The next day, knock, knock, knock. Craig, your house is worth $493.43. And you're like, okay. And they're ready to knock on your door the third day. You're not even opening it. Why, Craig? You're not selling. It's noise. So the only time I want us to pay attention to the price is when it's going down. We need to double up on our 401k contributions. If we're already in a stayed withdrawal and contribution level, go ahead and dump some more money in. Even if you're at the max and you say that, all right, I'm not going to contribute in November and December of the year. Because we know in the retail environment, when the price goes down, we get more value. And that ties in, Craig, with logging your wins and acknowledging your wins. If we log a win, we get to bat next time much more confident and much more poised. And confidence breeds confidence.
I couldn't agree with you more, Debra. You're right on point. Confidence definitely breeds confidence. Certainty leads to certainty. And I am so grateful, like I said, for you and for what you're doing. And Terry, thank you so much for bringing me in here and allowing me to come up here and share with you guys. I wish you all an amazing day, a phenomenal weekend, and I look forward to seeing you all soon, speaking to you all very, very soon. And Terry, as always, you are an amazing person, and I appreciate you.
Well,
Thanks,
thank
Craig.
you so much for joining us, Craig. I appreciate you and sharing your win here with us today and talking with the totally awesome Debra Morrison. Make sure you follow and connect with her because there's maybe some interesting opportunities there for the two of you. And so thank you for popping in this morning. I appreciate you. And Amy, welcome to the conversation. We're talking with the totally awesome Debra Morrison about boosting our money confidence this morning. And if you have a win you want to share or a question with regard to finance, I see that you are in the business of secret profits and having a totally awesome podcast. Yay, I get to invite you up to speak. Super cool. What's going on with you, Miss Amy, and welcome.
Well, thank you. I was just kind of catching in here towards the tail end of the conversation, but I appreciate your comments about the wealth. And this is one of the strategies that in advising clients that I don't see used often enough. We are in an environment where we have a lot of individuals that are inheriting IRAs. And of course, the IRAs, all of the balances are going to be taxable to whoever spends the money. I see two things that are missed. One of them is they need to make sure by looking at the deceased tax returns, if any of those contributions were non-deductible, because there's no point paying taxes twice on the same money. And the second thing is I find that people don't always understand that when you inherit an IRA as a beneficiary, as let's say I'm a daughter or a niece, I'm not the spouse, that money, I get an opportunity to pick when I pay the taxes to a certain extent. But if there's a balance left in this account at my death, whoever the next beneficiary is, they don't get the same options I do. They're going to have to cash the account and pay taxes on the entire balance. I encourage clients to, if they are not maximizing a 401k or an individual 401k for us self-employeds, IRAs, whatever you can do, to think about it in your cargo pockets. I like that picture. I can take the money out of the beneficiary IRA and I'm adding that to my taxable income.
Yeah.
But if I can turn around and take it back off and put it over into my name, for example, maxing out an individual 401k, I am not spending the money, but I'm also greatly increasing what my beneficiary options are going to be going forward. And I see too often people let those beneficiary IRAs set when repositioning it with a different title would be much more effective. And I'm finished.
Yeah.
Well, thanks, Amy. That's excellent. And I always like to have a couple generations on those beneficiary forms, because now, again, I sold my practice and I haven't been practicing since last September. So, and I know the rules did change in terms of, the stretch and so forth and so on of the IRAs. But if you, if you want to step back, if a family wants to pass wealth, then the first beneficiary, the first generation, if you will, could step back and disclaim, and then it would otherwise go to the other named beneficiaries. But if we fail to name a second generation beneficiary or beneficiaries, then we lose that opportunity. So great point, Amy. I like the attention to the detail, and definitely I'm all about maximizing after tax monies, because it's what we keep, not what we make. And the tax code is ever changing.
Practice after 25 years in 2016.
Wonderful.
But I also have a very detailed income and tax planning. And as I was listening to some of your comments, the other thing in working with clients that I think is essential is learning how to work the brackets.
Yes.
Because there are years when, and I had this with some of my clients last year. Let's face it, last year was horrific financially for many people.
Mm-hmm.
And I reached out to several of them and said, look, I know that this sucks. Your income's gone down, but you know what? This is the time. We have got to take some mass quantities of your IRAs and convert them over to Roths.
Yep.
I know you don't like this, but let's make a little bit of lemonade, because in many of these cases, they were able to deduct these contributions at the higher tax brackets.
Exactly.
24, 32. Well, things have sucked, and the way we have changed things, now you are down into a 22% bracket that you are never going to see again for a while.
Mm-hmm. Mm-hmm.
And so there's lots of opportunities, but many times I think people are reluctant to talk to a qualified advisor, their tax person, about what can I do.
Yeah.
They're not going to see them in September, October, November, when you can do something before the end of the year.
Yeah.
Because the spring is just too late.
Yeah.
And I'm finished.
We were totally talking about that a little bit ago, Amy. I so appreciate you jumping in to our clubhouse and engaging in the conversation. This has been awesome. We are at the top of the hour. So for those of you who are tuning in to our YouTube live, we're going to go ahead and wrap this conversation up. Debra, if there's one piece of advice that you would give your younger self today, what would that be?
Wow. Well, I was always a pretty active risk taker, calculated risk, of course. Yet I would like to take compensated risks. And there's a difference between compensated risks and uncompensated risks. And as I inherited clients, some of whom had done it themselves, they were taking uncompensated risks. And so you can still get the flurry in the butterflies in your gut, like, hey, this is fun, right? If you take compensated risks. And so, you want to delve more into those distinctions, or just, email me, team@womennavigatingfinances. But I guess that would be a pretty good way to maybe eliminate some of the mistakes, if you will, is to be very cognizant of, is this a risk that's going to give me a return? Because risk is a 4-letter word, but it is the currency for our return. And so it's best that we embrace risk in a way that pays us back. And that's to know what is compensated risk and what is uncompensated risk.
Fantastic. Thank you for such a great tip. For those of you who are listening, who are tuning in, do us a favor, like, subscribe, go ahead and follow us if you're tuned into the Clubhouse room. We always are looking for speakers here on the Terrific Tips podcast and Clubhouse. And we're always happy and thankful to connect with business owners who are wanting to expand their brand, share their area of expertise, and truly support and connect with other amazing people around the world. I'm Terry Watkins, your host and your chief idea catcher over at Spinfrogs, where we help you catch the ideas that stick. Thanks so much for tuning in today, and I look forward to